Hey there, and welcome back to the Fuse Show. Today I'm joined by Mike Barreiro. He is an experienced technology executive with a demonstrated history of working in numerous sectors of the industry. He is skilled in software development, databases, agile methodologies, and Amazon Web Services. He's also a strong information technology professional with a BS in computer science from the University of California, Davis. Thanks for joining us on the show.
Thanks, David. Glad to be here.
So out of all your experience in tech, how did you feel like your experiences led you to where you are today?
I think people take a lot of different career paths. And if you look at mine, I even have a slight detour in the middle. I started out in tech. In the middle, I actually became a police officer, and that's probably for a whole different podcast. But I've been in tech now for about 20 years overall. And throughout the years, a lot of my early career was spent doing random jobs at random companies. So I had a pretty wide breadth of experience, going from startups to large companies like HP and NEC, and then really came back to startup over the past 6 or 8 years, going from a smaller company that turned out to be fairly successful here in Sacramento, which is where I'm based and where one is headquartered, in the real estate space, and then transitioned into banking and into fintech from there. And previous to one, I was at a company called Aslo, which is a small business banking platform, which recently sadly had to shut their doors due to the bank closing them down. But that was a great experience and a great foray into fintech, and led me here to one, which is exciting and more in the consumer space, which is super appealing to me, both from a reach perspective, because small business is great. It is also, consumer adjacent, but you don't get the reach that you do when you're going direct to consumers at the scale that we are doing it now.
So I imagine when you're in the police office academy, you're probably one of very few people with a computer science background. So
yes.
Can you elaborate on that story? So the reason I asked is my co-founder also was a former police officer who became a detective, and eventually he moved his way into SaaS and podcasting as well. So I would love to hear how you did it.
Sure. I mean, early on in my career, and we're talking a few years in, so I went to college for computer science, came out, I love engineering. I was doing, like I said, a few different jobs at different places that were, started out at a smaller startup. It was great. I got a lot of experience. And then really overall, the sitting behind the desk and coding and staring at a screen all day wasn't very personally fulfilling. And so I said, I really need to do something that's more service-based. And in fact, I was going to join the military, but I couldn't due to a childhood illness, or, I had asthma when I was a kid, and that's a disqualifier. So the next best thing I could think of, service-based, and also had, I was in my early mid-20s. I wanted all the action. And so I said, well, I'm going to be a police officer. And that's, I really wanted to do something that was a little bit more giving back and a little bit less boring, to be honest. Because at the time I had some relatively boring computer science type jobs that were directly in my wheelhouse, but also weren't very rewarding. And so I joined the police academy in about 2005. So we're going back a ways, but yeah, I really enjoyed that experience. A couple things along the way kind of took me out of being a police officer, and that was not a fun time. I didn't do anything wrong, so I'm not trying to be cagey or anything, but it was really good in the sense that it brought me back to here, because honestly, if things hadn't gone poorly, I'd probably still be there. My brother's in law enforcement, big fan of the police officers in general, but what I'm doing now is so much more exciting. And in contrast with the early days when I was not excited about my job and when I wanted to change, I don't have those same feelings now. And I'm certainly not old, but I do think that a police officer is a young man's game. It's a tough job, and it's not easy to do.
What are some things that you learned back then that you carry forward, like as just a life principle?
I think one of the things that they really drive home is always being prepared, always being alert. In some ways, because police officers are so much at risk when they are on the job, you kind of take that home as well, where you're just like always aware of what's going on around you. And I think that's important in business, to just not get complacent and, not that you're worried about somebody trying to hurt you, but just in general, having that, don't get comfortable where you're at. Always be out looking around, seeing what else is out there, from a, not necessarily a threat perspective, although in engineering, we definitely have our share of threats, not physical, but as far as cybersecurity and data privacy and those types of things. And I think that is really important for anyone in business. And that's one of the big benefits. I think the other is, just the work ethic and the just keep going, the perseverance that you kind of need. There's a lot of challenging things, again, less physically, but a lot of challenging things in startup and in business where if you don't have that kind of fortitude to keep going, it's can be a real challenge. And I think a lot of people burn out, and a lot of people don't, they start off really high in startup and they say, this is awesome, and do this big thing. And when the going gets tough, they can't keep doing it. And they end up either falling back to another more, stable job, or going down a different path because it was just too hard. And I think, grit, fortitude, all of that is very necessary when you're doing startup, because things rarely go your way. And I think the successful people and the successful companies will tell you it wasn't always as easy as it looks, nowadays, when they get to the point where they're huge and it's like, oh, look at that big company. They had a lot of struggles when they were early on. And I think everybody goes through that. You should recognize that, know that it's coming, and just get through it.
One of the reasons I started this podcast is to capture exactly what you just shared, the fact that the path of being an entrepreneur is very, very difficult, but also at the same time, the fact that it is difficult makes it exciting and rewarding. I think you called out the fact that you found, you said, I think your first computer science-based jobs were on the more boring side. Or like, I totally agree with that. I think most jobs are in the realm of like programming are actually on the, I kind of call it like digital plumbing, where like the job needs to get done. It's very clear what needs to get done, and you just need to put in a lot of time to get like connect component 1 to component 2, do some relatively basic database queries, like render generally basic things. And I feel like that's a bulk of what most software engineers do at the like new grad level. So how did you go from? Go ahead.
Sorry, I was just going to say, I think in the beginning, that's really exciting, because when you're doing something new, almost whatever it is, it's really exciting. And even like as a police officer, when your first few months is just like so much new, and so there's a ton of excitement. And then I think if you ask most police officers as they go throughout their career, especially the ones who have 5 or 10 years in, which is a long time for a police officer, those things that were exciting become boring. Like things that you and I think are very exciting, like, high-speed chases and, situations where you might require a gun. Those are very thrilling, maybe not exciting, but certainly thrilling. Those become normal to you as a police officer. And in some ways they become boring. And I think the same with almost any job. Being a new a new computer grad, you come in, you're like, oh, I can do all of these things now. You have a lot of theory, right? In college, you don't have a lot of practical experience. And then you come out into the real world and it's like, I'm going to go build something. And you build these things that are not super exciting, but as a new grad and as somebody who hasn't really done it before, they are exciting for a little while. And then a year down the road, you're like, okay, I've done that, especially when you're young, you think, I know everything now. Like, what else is there? This is boring. And so I think the newness of whether it's a job or a project, you get on a new project. I think most engineers, they like to move around, right? They don't want to work on a project for 10 years.
Right.
They barely want to work on a project for more than a year. A year's about kind of the I don't want to say breaking point, but certainly the point you kind of get, well, maybe I want to do something else. This becomes the same thing every day. Even if you're doing new things that might be slightly challenging, you just want like a whole new, let's change it up. And one of the things I really love about startup is that it's a new thing every day, pretty much. Whereas if you go to some of the larger companies, not that they're bad, but you are a bit of a cog in a machine, and it's like, here, go do this work. And it's a little bit rote and a little bit, unfulfilling, but it's a job. I think with startup, there's nothing boring about it. It changes every day. A lot of days it's scary, a lot of days it's fun, but you don't get that boredom or that sense of, I need something different. Unless, like I said earlier, for the people who maybe are just like, I can't keep doing this. I can't keep having all this change. I can't keep having all of this stress and this pressure, which is there with a lot of startups. So there's a trade-off, but I believe, when you're at your job 8, 10, 12 hours a day, hopefully not too much more than that, it should be something that you really love. It's at least a third of your life spent at this thing. You should really love what you're doing. And if you don't, you should probably find something else.
I definitely agree. How did you go from being a police officer who wanted excitement in their life to finding excitement again in the world of software engineering?
Yeah, so when I got out, I went back to software because that was I was trained in it. I had lots of experience. And it was also the thing that don't get me wrong, I still always loved engineering. It's I think for most engineers, it's kind of core to them. They are people who are hopefully a little more logical and are like problem solving. And that's really, engineering is not about writing code. It's about solving problems. And so that was always a big part of me, even when I was a police officer. Coming back out, I went back to that. And my first job was definitely more of a job. It was fine. And it was new. Again, it was new. So it was like, okay, this is exciting. You get to learn a lot of new things. You get to work with a lot of new people. And all of that keeps you, kind of motivated and engaged for the first few months, the first 6 months. And then I found myself, feeling this is the same. This is what I used to have. After 6 months or a year, it's kind of boring again, especially if the company is not particularly dynamic. Even though it was a smaller company, it wasn't really, nothing was fast paced about it. It was just very mundane, day to day. And so I made a change, maybe for the worse. I'm not going to say where I went to because that's rude, but it was a larger company and it was even more mundane. And I got to say, there were some days where I literally, I'm being very precise here. I literally did not talk to one other individual for the entire day. And that's, pretty sad. And I only stayed there for a relatively short amount of time. And then I found startup, and I mean real startup. And that was here in Sacramento. I was at my boring job and a recruiter for this company reached out, and normally I don't answer. I mean, if we answered every recruiter call or email that came through our doors, we'd be very busy. Normally I don't answer them, but she sent a video, a YouTube video about this company. And so I watched it and I was like, wait a minute, there's a startup, like what you think of as Silicon Valley startup. There's a startup here in Sacramento, like that. This is unheard of. And this was, going a few years back, but it was kind of always thought, at least in my mind, in the Sacramento region, that if you want the startup life, you have to move to the Bay. And a lot of people don't want to do that if you have a family,
Right.
and I had a family, I have kids, and that's a pretty big ask to up and move everybody to go have that kind of life. And so this was like, I can have this startup. And back then also, like, remote work was not really a thing. Most companies required you to be in the office most days of the week. So you kind of make that choice of either if I'm gonna live in Sacramento, you can commute, which is horrible, or you can move, which I wasn't, at the time I wasn't willing to do. And so never really got that true startup experience. And when I saw this video and I was like, that place looks exciting. That place looks like, fun. That's when I really got back into engineering, because again, like between being a police officer and when I made the jump to, Skyslope, it was relatively boring in between. I didn't get excited about what it is that we do now until I had that experience. And I'm like, this is, and to be honest, I had done smaller kind of startup companies previously, but they weren't anything close to what Skyslope was, or certainly not what like one is. Back then, a lot of the startups that were in Sacramento, like early on, we're talking 2002 era, were really more like mom and pop type startups. I mean, they were just, for lack of a better word, they were a small company. They weren't necessarily, and maybe been around for a couple of years, but they weren't the startup that you kind of have this big idea and you want to go and get lots of customers and do big things. It was a little bit less grand on the scale side. So Skyslope really was the first like true introduction to that, and it got me really excited, fired up. We were on fire for literally 3 years, and then Skyslope was acquired by Fidelity, and ended up moving on from that because it kind of gets boring after you get acquired. Moving into banking.
Can you elaborate on that? What makes an acquisition boring as an engineer?
Well, I think, most of the time things slow down pretty drastically when that happens. Everybody has to get aligned with the new company vision and all of that sort of thing. And it really also hinders your ability to make progress with what you were trying to do previously. Obviously, now you essentially have a new boss. It's no longer your CEO. It's, this new company, and they have their own objectives. And so now they didn't acquire you just because they like you. So now you have, it's kind of a bit of serving two masters, and also just this feeling, at least for me, of we've already kind of hit the top.
I see.
And where do we grow from here? And so I think for me personally, and this is not everybody, I like the dynamic nature of startups. And once it becomes not dynamic, it becomes less exciting. And, I like early stage startups. I'm totally fine to even maybe go through the first few rounds, right? ABC, hopefully along the way, there's an exit, but that's not always the case. And then find something else that's exciting again. Because once you get to like that big, okay, now we're a multi-thousand person company, and not that Skyslope was at the time, but once you get to that, to me, that is far less interesting. Because one of the other things I really love about startup is the scrappy nature and the ability to work closely with a relatively small team and to accomplish a lot of things in a small amount of time without all the red tape, without the 3 weeks of process to make a decision. It's like, we make a decision now, we go implement it after lunch, it's in production tomorrow. Like that kind of speed and that kind of change is really fun for me. And as you grow, it changes. I don't care how big you are, that just changes. So leaving SkySlope, it wasn't, it was kind of sad because you do feel like you've contributed so much to build this thing up. But also at the same time, jumping into banking was, again, totally new, totally different. And I think for a lot of people, especially myself, you kind of think about banking, you're like, that sounds pretty boring. I mean, how could you get much more boring than banking? It's debits and credits, you hold people's money, like that doesn't sound exciting until you get into it. And then you realize how much there really is. And also, I think for what we're doing now here at One, it's really exciting to be able to solve a problem that you kind of thought was solved. I think most people look at banking and say, it's already been done. It's been done by many different players for many different years. Like, what else is there? Like, how hard is it to hold somebody else's money and let them spend it when they want to? And that, I think, is where a lot of the big banks miss, and where a lot of the challenger banks or the neobanks that are out there, similar to us, are trying to make a difference. But I think the big differentiator is really on the customer service side. And I don't just mean the person who answers the phone and is able to help you with a problem. I really mean in the banking should be a service for the customer. We are not there as some, I think it's interesting that people essentially, for most of the big banks, they hire this institution to hold their money, which is a benefit to those banks. They hire in the form of, fees and, I'm paying you for the privilege to hold my money. And that's always been a little bit odd to me. And I think a lot of the neobanks, and especially One, we don't have any fees. And that alone, I think, is such a departure, because most banks are trying to add as many fees as they can, as long as they make sense. This makes sense. You did something wrong, or you want this thing, so we're going to charge you for it. And their purpose is to extract as much of your money from the bucket that they are holding from you, which is just so weird to me if you actually think about it. Because you have now said, I would like this company, I'm going to choose this company to try and extract as much of my money as possible. And I'll just try and make sure I don't screw up so that I don't have any of that happen. And then they're doing a good job because I didn't have to pay any fees. And so this relationship is working. But all the time, I mean, banks make so much money off their fees, and mostly because I don't think most people know that if you're a large bank, if you're a large institution, $10 billion or more, they're regulated on the amount of interchange that they can receive based on the Durbin Act. And so these large banks, they don't care that much about you spending money on your card or on your debit card, because the money that they receive from that transaction is small. The money that is charged essentially to the merchant, it's not charged to the customer, it's charged to the merchant at the point of sale. When you run your card, a very small amount of that goes back to large banks. A lot of the smaller banks and for banking platforms like One, we get a much larger percentage of that. Again, this is not coming out of the consumer's pocket. This is part of the 2 to 3% that the merchant is paying in order to have the card network. And so a small institution like us has a lot less overhead than a B of A or a Wells Fargo or those big banks. And we get a much larger percentage of those card transactions. And so you're talking about a much lower cost and a much higher revenue. And again, we're still talking small amounts, but in general, we can make that model work. Banks can't. Banks cannot survive on card interchange. And so they have to look other places. Of course, they make a lot of their money on lending as well, but fees are a substantial part of any bank's portfolio. And that to me is where the customer service or the lack thereof really comes into play. And again, it's not do we have 24/7 support,
Right.
like that type of customer service.
Experience.
It's really the serving the customer. Yeah. And if you are trying to take money, we don't try to take money from our customer ever. Like that is not our goal. We take a percentage of the money that's out of the card transactions that they make. But again, it doesn't come out of the customer's pocket. We don't charge any fees, and I think we have a very unique part of our platform or of our accounts is that you can go negative in your account without paying a penalty. So the way that we've kind of envisioned this is that 0 is just an arbitrary number. And like going below this line should not mean that now you have to, you go below by $5, now you have to pay like a $35 fee because you borrowed $5 from your bank for like maybe a week. That's outrageous. And if you calculate the percentage of, what that would work out to if it was an APR, it's in the like thousands of percent. Like, I borrowed $5 for a week. I now pay $35 for that. 0 is just, sometimes you go below 0. It's not a big deal. And what we end up doing is we've essentially, and I'm going to use words that are, they are more well-known by consumers, but I think also it's a double-edged sword when you use well-known words because people get these preconceived notions. I know what that is. If you say bank, I know what that is. If you say checking account, oh, I know what that is. And so I'm going to use these words, and I'll come back to like the words that we use, but I'm going to use these words mostly from the perspective of being able to bypass some of the education that is required if you use a new word, and say, we've essentially married a checking account with a credit facility. Think of it like a credit line. And so you can go below negative, you can go below 0, we will cover it. And as long as that gets paid back within your monthly cycle, there's no fees, there's no interest. We still don't charge any fees, but if you carry a balance over time, we charge 1% interest per month, which is very reasonable. We're talking 12% APR. It's lower than almost any credit card or any other credit facility out there. And again, we're not trying to extract people's money. That's more from a, on our side, a risk perspective, because some people won't pay that back. And of course we have to cover losses. But we've married these two things so that we can say, you can go below 0 and your next paycheck might be a few days away or a week away, right? But if you think of your account as a bucket, and so instead of kind of the paradigm now, where if you are, let's say you're at the grocery store and you have a traditional debit card and you have a traditional credit card, and you say, if you're smart and you think, I've only got $20 in my account, I've kind of done the mental math in my cart and I've got $30 worth of groceries, I'm not going to use my debit card because that's either going to bounce or maybe it won't, but I'm going to have an overdraft fee. So I'm going to put it on this credit card. So you do that, everything's fine, and you still have this $20, I don't want to say burning a hole in your pocket, but you've got this $20 over here that you now have available to spend again. So there are two problems with that, I think. One is that you've kind of now put this everyday purchase, this $30 purchase on you've financed it.
Right.
which is not a good use of a credit card. I believe, and we believe, that credit should be there for people when they need it, not necessarily when they want it, when they're like, oh, it'd be really great to go buy a boat today. Don't really have the money, probably can't afford it, but this credit card says I can.
Right.
So that to me is very predatory. And, of course, credit card companies love that idea because they get people to spend more than they really should. But by financing that grocery store purchase, you've now really abstracted away the amount of money that you have or that you think you have. And you've said, okay, this other thing over here can do it, and I will deal with it later. Well, the problem is that compounds because it's always later, and it's always just a little bit more money that I'm going to put on this thing. And because there's no, unless you're very disciplined, there's no immediate repayment mechanism there, or no forced repayment mechanism for sure. They're like, just give us $25 a month. That's okay. Of course they want to do that because they want that thing to grow and they want you to owe them forever so that they can keep making money on a more of like a subscription basis than an actual, they're not looking to get that paid back anytime soon. And so for us, we combine these two things together and we say, look, it's one big bucket and zero is just somewhere in the middle of this bucket, right? And so if you dip below, we've got you covered. When your money comes back in, AKA more into the bucket, it just fills that back up. There is no repayment there, right? So you don't have to think about how much did I spend? How much, do I have to pay? Should I pay the whole amount? Should I pay a minimum amount? I'm going to use, simple numbers, but let's say you make $1,000 a month and we've given you a couple $100 credit line in order to go negative. We call this, overdraft, right? I mean, that is a word that everybody knows and understands. Overdraft protection. So we give you a couple $100, you go negative by $100. That's fine. When your next paycheck comes in, your checking account, again, I'm going to use the words that people know, your checking account now has $900 in it because it instantly filled up. You were at negative 100 and now you're at 900. And that makes it much more easy for you to stay on top of your finances because you don't have this separate other thing that you're going to get a monthly bill for later and actually find out how many times you've compiled charges onto this thing. What we call our, if you want to call it checking account, we call it a spend account, right? And there is some education in when you say that to people, they don't really know what that means. They don't have these preconceived notions. So it is harder to say that, in passing. You kind of need a little bit of education. But I think there's a lot of power in using new words because you remove all of the baggage of a well-known word and you can, invent what that means. And for us, a spend pocket, we also call our accounts pockets. And I will talk about that too if we get to it. But our spend pocket really is about, this is the thing that you use to spend because there are different categories of money. There's money to save, right? That you're putting away either for a short-term purchase, like maybe you want to buy a laptop or you want to go on a vacation. Those are more shorter term. And then you have that rainy day fund. I'm putting away money just in case I want to have, 3 or 6 months of income available liquid in something that is safe. And that's very different from I go to Starbucks every day. I have money to spend, I need to spend. So we have a spend pocket, and that is what gives you this ability to go negative, right? If you're at the grocery store and you only have $20 of cash, quote unquote, in your account, that's okay. You can go spend 50. It's okay. We will cover the 30. When your next paycheck comes in, it will fill it back up. You will owe us no interest. You will owe us no fees. And for a lot of people, you can, because they have to, a lot of people are riding that line of paycheck to paycheck. They don't have tons of extra money sitting around. And so the way that I look at it, most paychecks are fairly cyclical depending on your type of job, but they come weekly, maybe bi-weekly, monthly. Life does not happen on that same cycle. It just, you could be 2 days away from payday or maybe 2 days after payday, and some expense that you never planned for, right? You tire blows out. Now you have to pay for a tow and a tire or whatever. The majority of Americans can't cover a $400 emergency expense. And that is, one, it's very sad, and that's almost a different topic, but it's really core to what we're trying to do. That should not be a huge problem for anybody. Certainly in America, and it is, because you don't have the ability to, what I would say, get credit when you need it. That's what credit should be for. It's like, hey, I need a little extra right now because I don't have enough in my account. I'm good for it. I have a job. I get paid every 2 weeks. Like, this is not something that is risky. I just had a bad thing happen, and bad things happen to everybody, or to everyone on a regular basis. And some people aren't able to handle it very well. And so what happens, financially, and so what happens is they turn to things like credit cards, which have really high interest rates, and of course allow you to pay just a little bit. We'll just let you pay a little bit back. And you're like, oh, that sounds great. I don't really want to pay back the $100 that I used. I'll just put 25. And then I have the $75 in cash. It's like you're setting yourself up for failure as you compound that. And so what we're trying to do here really is to say, look, we understand these problems. We understand the spending cycles for people and the income cycles for people. We give people these lines of credit, this overdraft protection in various amounts, and it's all based on how much do you bring in, to the platform? How much can you reasonably, we're not going to give you $10,000 to spend extra at the grocery store. That's not the goal. The goal is really to help you cover those cases where you come up a little short, either because of some minor catastrophe, or because you maybe didn't really budget that well, and you maybe had an extra trip to the bar this week. Like, that's okay. Like, that shouldn't be a stress for you, a financial stress, which so many people are dealing with these days. To have that comfort that your card works, that you're not going to be embarrassed at the point of sale and have it bounce, or to get to the end of the month and say, wow, we overdrafted 2 or 3 times this month. Now we have to pay $100 in fees to the bank. Like, these people are people who have the least ability to cover an extra $100 in fees. They're talking about kicking them when you're down. Like, they had to borrow 5 or 10 or 20 bucks from you, Mr. Bank, at some point during the month, and then you charge them, like, they had to borrow 20 bucks. You really think that they want to give you $35 out of their next paycheck in order to pay you for your awesome service? Like, that's where the human side, I think, of banks does not shine through. I don't think there is one, and again, I'm not saying banks are evil, but they are in the business of extracting money from customers in order to, of course, they have to provide services just like we do, but they get their money from a slightly different source than we do. They make a small amount from the merchants. They make a much larger amount from their customers, and we are the total opposite.
So in terms of the services, like, I think a lot of people like to go to banks because they have a physical ATM they can go to, a physical human being they can talk to, someone they can either email or phone call and get an actual answer back regarding some scenario regarding their account. How do you do that at scale off of, I'm assuming the margins you get off of the transactional spread is relatively small dollar amount wise to like cover for your team's like staff compensation. at scale. Yeah.
Yeah. So these really don't work except for at scale.
I see.
You can't run this if you have, 10,000 customers, because like you said, is not going to cover payroll for a team that's running this type of thing. And so we are VC backed. We were seeded and founded by Bill Harris, who's pretty large titan in the finance world. And when Bill had this vision, it was really to go big. I mean, we're talking big, and not going to go completely into the future roadmap, but it's not something that you just build a nice business that has 100,000 customers and you just kind of survive. Like, we wouldn't survive on 100,000 customers. And so we are VC backed. We probably will be for at least another round or two. I'm talking about, funding rounds. And then of course, at some point we will be break even, but that break even, you're into the millions of customers, right? And then at that point, you can actually cover expenses for, headcount and software and everything else. Again, because we don't have the brick and mortars. Now, you mentioned people like going to a bank because of the services that you mentioned, like an ATM. We have ATMs. They're not one branded. They are the Allpoint network, which is 55,000 plus ATMs around the country. So there's no shortage of places to get cash. I do think the majority of people nowadays don't even use cash. There are still a lot of people that do, but almost every payment, is electronic. Most merchants now are tap to pay, and so everybody's walking around with their Apple will just put that thing on the counter when you get up there, and you didn't even have to bring your wallet with you. So cash is, to me, it's an important component for a lot of people. Sometimes you need cash. Sometimes a lot of people are still more on that, and depending on your industry, they could certainly be more cash heavy. So we don't want to not be a solution for people with cash as well. But I don't think you need to have your own brick and mortar. There are these networks out there, these vast networks that are able to meet customers wherever they're at, and we get to leverage those. And again, no fees. We don't charge any ATM fees using the Allpoint network. So we have that. As far as customer service goes, like the actual, can I get somebody on the phone? We are far more available than banks are. In terms of when you call, you don't get routed through a phone tree of 27 questions and an AI bot going to try and help you out and maybe direct you to a website and give you an article on how you can fix the problem. When you call, you will get a human, or when you email, you will get a human, or when you chat, you will get a human. We have no AI for CX. CX meaning customer experience. We are, and of course we are a little, on the smaller side. We're not Bank of America. We don't have 10,000 agents. But we also don't have yet, we don't have 100 million customers. So when we, as we scale, of course, we will need more, but we have a very talented team of, customer service individuals who really are just wanting to help the customer. And I think that is a different thing too, when you get to scale, and especially when you have that, and it's a challenge that we will have to solve as well. Everybody on our customer service team is really tied to the company and tied to the vision of the company. And when you get to be big and you have a call center in Mumbai, nobody there cares about the company. It's a job, right? It's a job. They answer the phone. Most of the time they're dealing with a customer that has a problem. So customer might be irate, and they get a little bit jaded, and they're also disconnected from the company's vision, and really from the customer. And so the way in which you deal with a customer, I think, is very different when you're like, this is my customer, or I work at a job and they pay me to answer the phone and, try to not get a bad rating. I mean, they're two very different mindsets. And for everybody here at One, we're really, everything in the product, everything on the customer service side, it's really how can we do the best thing for our customer? And of course, we are trying to monetize this, but we have a plan, we have a roadmap, and the business plan is not how do we pull the money from our customers? It's how do we, provide a service that we can support via things like interchange. Also, we will probably have in the not too distant future, more of like the freemium model where you get all the same services that we have today for free. But if you want this extra premium thing, maybe you want, a designer card, you want a metal card, you want, that's fine. Some people really want, they care deeply about what's in their wallet. We can give you that for, not a fee, but for a subscription, or for, you pay 20, 30, 50 bucks, whatever it is, and you can get that thing, but that's your choice.
Mm-hmm.
And I think the difference between something of value that you're willing to pay for because you've made the choice is very different than a fee. Fees
Right.
get done to you, right? It's like, oh, I didn't want to pay you $35 to borrow 5. You didn't really give me an option. I ran a charge that was $5 more than the amount of money that I had in my account. Now I have a fee. If I consciously make the choice to say, even if, and it, would not be this expensive, but even if it was like $100 a month, if I'm saying, you know what, the value here for me is worth more than $100 a month, I am going to pay that. I don't feel bad about it.
Right.
And a business shouldn't feel bad about charging that if it's up to the customer. Right. I think a business should feel bad about charging things that the customer did not ask for, like fees. And so we probably will have in the not too distant future that kind of model where you can choose maybe we have pockets, and right now customers can make all kinds of pockets. You can categorize your money and say, this is my grocery pocket, this is my automobile pocket, this is my vacation pocket. And so you can really, it helps you to budget, it helps you to organize things. And, maybe at some point we say, okay, we look at our customer base, most people make 5 or less pockets. That's what we're going to say is free. For some of you, you like to have 50 pockets or 100 pockets or something. Those do actually cost us money. And so right. We can't really do it for free forever. Certainly not at scale. We can't have everybody just making 100 pockets. And so maybe we say, okay, we're going to, the bulk of our customers, this is a good bar to say, these are free. And it's also reasonable to say the costs associated with this amount, we can afford with things like interchange. Anything after that, look, you really like this, great, you see value for it. What if you paid, a couple bucks a month to have an extra 10, 20, 50 pockets, whatever it was. And then I think it's one of those choices that somebody says, yeah, I would like to have that thing. I'm totally willing to pay $2 a month for that. So, interchange is not our only revenue model.
I noticed I saw some loans also on your website. Are you trying to get into?
Yes.
Yeah. Okay. Can you elaborate on what it's like to be a fintech trying to start up or connect consumers with loans?
Yeah, it's very different. There are a lot of neobanks in our space. Almost none of them do credit, and there are good reasons for that. We have a slightly different relationship with our sponsor bank and with the stack that we have put together, which makes it very, very different and much easier for us to offer credit. And so we are doing that. We have various flavors of credit, one being overdraft, right? That is a form of credit. We're giving you credit for a certain amount of time. And floating that, the facility to float money to your customers is credit. it's whether it's a credit card or whether it's overdraft or whether it's a term loan. And so that's one flavor. We also have, for the people who want to consciously finance a larger purchase, again, I would say don't use this at the grocery store. Use this more like a credit card if you were using a credit card more responsibly. Is I would like to put this $1,000 purchase on, it's going to take me 3 months to actually pay that off. So let me make the choice to finance that. So we have that discretionary credit where you don't necessarily have to go below zero in order to borrow it. And then very recently, and we are in the process of launching that credit line, which is, it's more of a discretionary credit, but for people who are wanting to finance a purchase at the point of purchase. So not saying I have a one account already, I would like to, we have the ability to, the card that I showed you earlier, the card that you have in your wallet, if you have 3 pockets, including like your credit line, you can move the card in between each one. You can go into the app and say, I want it to pull out of this real time. So if you're going to the grocery store, you say, pull out of my grocery pocket. So when you swipe the card, the money is going to come out of the grocery pocket. Instead of that, at the point where the customer is making a purchase, they say, this is a large purchase, right? We're talking things like maybe like home improvement projects for I'm going to paint my house, or I need a shed in the backyard, or those types of things, where typically people are probably financing it anyway. They're not going to cash. They're saying, I'm going to put this on maybe a credit card. Again, I think credit cards are doing people a disservice. They're kind of a general utility, and because of that, and because they are so misused, they charge really high fees because in some regards they have to. I'm not saying that they're doing it all right, but in some ways they have to because of the losses. But if your user base is using credit responsibly, you don't have to have 29% interest for that credit, because it was a conscious decision to make this one-time purchase. And so it's almost more like a term loan, but instead of making it a term loan, it's, I'm going to pay for this thing, which is a home improvement project, which also kind of reduces risk. Again, we're not talking about people just going crazy at the bar or going out and buying a boat. But I'm going to put this on some type of credit facility, and one has a really great offer. I mean, we're talking, again, that 1% interest rate, and they can come to us, what we would call a credit first customer. They didn't come to us for their primary banking relationship initially, but we can offer them a really great service and a much lower interest rate than most for that purchase. And in the same kind of paradigm, we are also launching term loans, which are fixed payment, you know exactly how many months it's going to take to pay off, and same type of thing at the point of purchase. I want to buy our washer and dryer. It's $1,000. I'm going to pay $25 a month for the next X months, and introduce people to a lot of the one concepts through that initial credit relationship. And so that is very different from a lot of the other neobanks in the space. Most neobanks are running off of interchange, and they do well, and that's fine. But I think there is a bit of a lack of diversity in the revenue models with a lot of those as well. And so I think there's a lot of new coming out here soon, and I think. And not just with us. I mean, in general, I think there's a lot of new in the fintech space. I think a lot more startups and a lot more companies are able to offer banking type services without being a bank themselves. And so we have a wonderful partnership with our sponsor bank. but we are not a bank ourselves. All of the money is held FDIC insured. It is all, it is all above board. Everything that we do is bank level encryption. So most people would say we are their bank, but technically all of these neobanks are not banks. They have a banking, some type of banking platform under the hood. And I would say the differentiator for us is we are a bit of the banking platform and the product. Whereas a lot of the other neobanks, they built a product on top of a banking platform. So people who are in the fintech space, they've heard names like Bancor and Galileo and Cross River, and all of those are kind of bank as a service platforms, which they provide APIs to their customers, which are fintechs that say, we can hold account, we can create accounts, we can create cards, we can move money. You talk to these APIs, we handle everything under the hood. So a fintech can kind of start up and say, I'm going to build this product, which is a nice, GUI on top of these other banking as a service platforms. We did things a little bit differently. Again, Bill was really thinking long-term, big vision when he started this thing. And I think Brian, our CEO, Brian Hamilton, came in and said, we've got to do this from the ground better and more differentiated. We can't just throw a nice UI on top of another service that's out there. We have to be a big component of that service. We have to build that ourselves. And yes, it's going to be slightly more painful. And yes, it's going to take us a little bit more time, to get to market. We've been out now for, in production for approximately 9 months, 10 months for Joe. So we had close to, almost at least a year and a half build before anybody ever saw anything. And I think it's not because we were slow, it's because we really built a differentiated foundation under the hood to be able to offer these different kinds of services, to be able to offer things like, the ability to have these multiple pockets, which under the hood are physically, different externally addressable accounts. It's not some kind of accounting trick. We have separate accounts that we are creating, and the ability to take this card and point it at any of those individual pockets. That's very different. The ability to offer credit in the way that we're doing it seamlessly within our core, not when combined some, there are credit companies out there that do a great job, like Cabbage and Bluevine, and they offer a service, credit as a service, right? And so I could see maybe a world where a fintech comes in and says, okay, we want to take a bank core and have that be the banking side. And we want to take, a Cabbage and have that be like the credit side. And we're going to put this layer on top that marries these two things. But it's not really your system. Again, you're just kind of an integrator at that point, putting a UI on top of two different subsystems that don't even talk to each other. We've done things completely differently. Our entire stack for credit, for banking, it's all self-contained. It's all within one. And I think that's really going to be one of the things that allows us, although maybe we were a little bit slower out of the gate, one of the things that's going to allow us to move much quicker as we grow and as we get bigger and as we want to offer different types of services to our customers.
One of the things you mentioned earlier was the risk component. And you mentioned how also you're not technically a bank, you're the product for the consumers that might view you as a bank, but officially on paper, legally, you're not a bank entity.
Correct.
So as it relates to risk, are you the one that bears the risk, or is it the bank that bears the risk? Do you bear the risk together? Do you build the risk model? Do they build the risk model? How does it all work out?
Yeah, so we control all of that. And as far as the funds themselves, all of our funds, I want to be very clear. You can look it up on the website. You can look at all the terms. FDIC insured, held at the bank. We don't it's all held digitally, obviously, but there's no bank anymore. There's no vault with money in it. But all of that is obviously protected by the bank itself. The movement of money and all of the, whether or not we let a customer through the door, right? That process, normally known in the industry is like KYC, know your customer. We have to validate that the person signing up is a real person and that they are the person whose data that they're entering into the platform. That type of risk, that all falls on us. When somebody they want to make an ACH payment, which is like, your typical bank-to-bank payment. I want to pull money out of my Wells Fargo account because I'm leaving them because they charge me too many fees. So I'm going to pull it into one. Those money transfers, that risk is on us. And so we take all of the appropriate measures to both, for people coming in the door, validate you are who you say you are. And then also to say, on these ACH transfers, we're doing something pretty novel in that most banks ACH transfer somewhere between 3 to 5 days, just depending, because there's risk in that, right? The way that the ACH system works, that could probably be a whole podcast. But essentially, you have this, if you're talking about a pull, which is like somebody who is in one and they want to pull money from Wells Fargo, there's risk there because what we are doing is telling Wells Fargo, hey, we're taking money out of one of your customers' accounts. Now they happen to be one of our customers too, and we believe that because we've gone through all of these KYC, procedures and we've mitigated the risk there, but we are pulling money out of one of your customers' accounts. And essentially the way ACH works is as long as the money is in there, Wells Fargo says, sure. Wells Fargo did not initiate the transfer. One did, but ostensibly one's customer did. That transfer has risk because if that Wells Fargo customer comes back later and says, wait a minute, I didn't do anything. I didn't pull any money out of my Wells Fargo account. How did this happen? Wells Fargo comes back to us and says, hey, give us back that money. That's not, that was not real. And that risk there is, it's very real in the banking world, as well as somebody trying to pull $1,000 out of their Wells Fargo account and they only have $500. We don't know whether or not you actually have $1,000 at Wells Fargo. We can maybe do a check before you actually make the transfer. But then again, the way the ACH system works, none of this is real time. None of this is like us calling up Wells Fargo and, electronically and saying, hey, transfer over this money. This goes out on an ACH file, tonight, or maybe within the next couple of hours. Wells Fargo is going to get that tonight or tomorrow morning or sometime. They're going to make a decision and they say, wait a minute, this person doesn't have any money. During all of that time, of course, a customer could have, even if they had money at the time that they made the transfer, they could have pulled money out, or they could have forgot that their mortgage payment was going to hit that night. And so the money ended up leaving their account, by accident. But we get back a signal a day or two later that says, wait a minute, there's no money here. We're not making this transfer. So if we are to give the money to the customer any sooner than we get that signal back from the other bank, there could be loss there on our side, right? And so we do things to mitigate that. But what I was saying that we're doing that's a lot more novel is that we have a partner, wonderful partner called Orem, and they give us insight into the likelihood that a transaction will actually come back as NSF, non-sufficient funds. And that in conjunction with some other decision-making on our side as to whether or not we want to give a customer the money, essentially kind of on credit. We're saying, you know what, we feel like you're good for it, right? Whether it's because you're a good customer or because Orem has said, this is not risky. This person owns that other account. This is obviously not a case of fraud, and nothing's ever obvious, right? In the data science world, but this is far more likely that it is not fraud. We can give that customer their money the next day. And in fact, shortly, we can give that to you immediately. You want to make a transfer? We will handle it under the hood, and it might take a day or two, but we're going to give you that money immediately. And that is very different because, again, it goes back to risk. But if you can mitigate the risk, then you can provide a much better service for your customers without also taking, huge financial losses for your business. So, and I do think a lot of these things are the things that the smaller neobanks and challenger banks, like we are equipped to be able to do, because we can move faster, because we can use these new vendors that are, state of the art and are, they themselves are probably just starting out, have a couple of years under their belt, but they're also really good at what they're doing, and we can leverage that. You're not going to get that kind of buy off, and you're not going to get those kinds of quick builds and iterations at a large institution, because, as much as they would like to keep up, there's so much more bureaucracy. There's so much more, there's huge roadmaps that, they have a 5-year roadmap. I mean, for a startup to have more than a 5-month roadmap is pretty aspirational. And so I think you will see in the space a lot of new interesting things coming out, and not least of which is one. So
when it comes to the consumer's perspective, as they sign up to be a one user, if they do go below that 0 threshold, does it affect their credit in any way, or is it independent of credit?
It's independent. And I will say on the credit side of things, yeah, so to answer your question, it does not affect their credit. We are basically on that overdraft, we are allowing you to borrow that money with the understanding that your next paycheck or your next incoming funds are going to pay that back. On the discretionary credit line, if you more like a credit card type facility, which has a lower interest rate, we will report if you don't pay it back, of course. But on credit, we also have a lot of our customers, or would-be customers, they don't have the best credit, either because hard times, maybe they used to have good credit and more recently COVID really impacted them, or maybe they just made mistakes in the past, but now they're like totally able to repay things. And I've always said credit score is a lagging indicator. It is what you've done in the past. It is not how credit worthy are you right now. And it goes both ways too. You may have paid every bill on time in the past. You just lost your job 2 months ago. Credit bureaus really don't know that you're not bad until, I don't mean bad, you're not a good credit risk until you miss your first couple payments. And then they get reports from each of those different, credit facilities that say, this person didn't pay, now they're 30 days late. Well, that is just as bad of a signal as the opposite, where somebody has a 600 credit score because they happened to lose their job a year ago and didn't have an income for a month or two. Now they have a job again. That's the only time they've really missed payments, but that dropped their scores because they didn't make a payment for 2 months. And right now, the credit risk on them should be super low. But again, we're looking at a credit score that is, effectively looking at 7 years of history and just kind of gauging past performance is going to equal future. Well, that's not true. Kind of you and I were talking earlier about logic. That is not true. And so we're really looking at income, current income, what's coming into the platform. Okay, we know kind of where you're at. But also for these customers who might have a slightly lower credit score, maybe you have a 500. Credit cards are not willing to give somebody with a 500 credit score a credit card. And so we have something called Credit Builder, which is really for customers who want to improve their credit score so that they can get more traditional forms of credit. Essentially, because so many places use credit score as the benchmark of should I loan you money. Credit Builder allows you to it is, I'm going to use a word again that is more well-known. It's like a secured card. So the traditional model of a secured credit card is that a customer would say, I'm going to send you, Bank of America, $500, and you lock that up. And then you're going to give me a card that kind of works like a credit card, except you have all the collateral you need to cover it if I don't pay you back. And then you use that for some number of years, and you say at some point, I want to close this thing. I've paid all my money back. Please give me my $500 back. That whole life cycle can be shrunk down into real time. And so we offer that same ability to where if you have a credit builder pocket, you put some money in there, we temporarily lock it up, and then you can spend with your one card while it's pointed at the credit builder pocket. All of those purchases are essentially, it's similar to a credit card in the sense that we are going to report back to the credit bureaus on your behalf that you made, that you used, that you had an on-time payment every single month. Because even if you don't, quote unquote, pay us back, we will just take it out of the collateral that you've locked up, right? So we can show that you are a good steward of money without damaging, we won't damage your credit score because we are only going to report that you were successful at paying this back each month. And very shortly at any given time, you can say, look, I put $500 in there. I don't really need this anymore. I kind of want that money back. I've paid it back, or I've paid back. I only owe you $100, but you're holding $500. I would like to pull $300 or $400 back out and put it into my cash. You can do that, right? There's no lockup period where it's like, or there's no big delay in between that life cycle of put money in, use it to build your credit, take money out. We can make that much more real time and have that benefit for these customers who have slightly lower credit, are trying to raise that, are trying to build a good financial future. And for us, for one, we, even if other people in the industry won't take as much risk on you, if you're building your credit with us and we see this person is responsible, they have steady income, they are trying to better themselves, they're trying to better their financial life, they're making these payments on time, we will then start to have this blended kind of credit where part of your credit is secured and part of it is unsecured. And we can kind of move people along the spectrum of, it's not just fully secured, or I really trust you and I'm willing to give you, credit with zero collateral. There's a spectrum there that don't really think there's an offering out there in the market that allows you to, maybe you lock up $100, but your credit facility is 1,000, right? Maybe you lock up 500 and your credit facility is 1,000. There's a lot to do there. I don't think, we're working on a lot of it. It's not all fully fleshed out, but you can see a lot of these changes coming very quickly here in the next couple of months. We're very close on a lot of it. The credit builder product is already out there. We released that beta a couple of months ago. We're adding to it. We're making changes. We will continue to grow and continue to offer additional credit products that help customers instead of trying to hurt them.
Well, I've been very thankful for your time. I've definitely learned a lot. It's a little past over an hour. I also just
I appreciate it.
To your time. So I just want to end the call or end the recording for our guests on just one final question.
Sure.
What's the best way for our viewers to get in touch with you and follow along with your company's journey if that's something they'd like to do?
Yeah. So, our name is One. Company is onefinance.com. The URL for the company is onefinance.com. That's ONE, not the number, but ONE. And we also have social media, Facebook, Instagram, and we're even on Reddit. So you can find, there's all types of communities out there. We have lots of customers talking about One. I would say, start at the website, see what we're doing. You can sign up. We charge no fees. There's no sign up fee. there's really no penalty for you giving it a shot. We don't hurt your credit. There's no, we don't do any hard credit pulls. So there's really no reason for you not to at least check us out. And then also I would say, follow our social media, follow Twitter, Instagram, Facebook, see what other customers are saying, because, I think we are filling a need for customers that really hasn't been met honestly, by either the large banks or a lot of the neobanks. Large banks, very, very kind of not listening to the middle class. They really want to have the customers that have a lot of money because they make money off of that money. If you don't have a lot of money, they don't really care about you. And, they want to charge you fees because all of the infrastructure that they have, they need to support it. And your little $1,000 balance isn't going to cut it for them. So they need to charge for that. On the other end, you have neobanks who really are putting out a kind of a niche product in a lot of cases where it just does one thing that's really cool. And it's like, that's awesome. We should have that. What we've done is combine a lot of those things together so that we can say, look, you can have all these cool features and still have kind of that more holistic banking experience that maybe one of the larger banks offers you, but they just do a really poor job at it. And so we're really trying to fill that middle class void. And I think if you look at a lot of our social media and a lot of, obviously the website is coming from us, but if you look at what we're trying to do, it's really to help families, people who are living paycheck to paycheck, people who are in some cases like struggling, and just make a better financial product and a better bank for those people. So onefinance.com, I think is the best place to start, and you can go from there.